So, shall we start?
Yes, sir.
Ladies and gentlemen, thank you for joining us
Hi.
today for
Hi, good.
Parthiv, by your internet connection might be a little iffy. Anyway, I'll start. Thank you very much, everybody, for joining us today for this investment discussion. This is a new interest that we have put together, this group. And I will begin by introducing the speaker and the esteemed faculty. Our speaker is none other than Dr. Srishti Jain, who is an intensivist as a medical profession in Jaipur at the same institute where I am, and that is Mahatma Gandhi Medical College Hospital. But why she's a speaker here for us today is because she is an NISM 15 certified equity research analyst. And she is going to speak on a very controversial topic. And she has agreed to put her neck out, and we are very thankful to her for that. In addition to Dr. Srishti Jain, we have 4 other esteemed faculty who are our expert panelists. I will allow me to introduce them as well. Mr. Malay Gandhi, who was previously vice president with Kotak Securities Limited, and he is now a founder of Footprint Group of companies. He has 32 years of experience in the derivatives market and is a very well-respected research analyst. We also have Dr. Arun Kumar Singh. Like Srishti, he is also an intensivist, but today he's here because he is a professional fund management consultant and a technical analyst. And these qualities of Dr. Arun Kumar Singh exist for stock, for commodities, for forex, as well as for crypto. So we'll, involve him in future programs as well. From Ahmedabad, we have an endocrinologist and diabetes specialist, Dr. Hiren Patt. And as he describes himself, he's a defensive investor and a value buyer. I wish I was a value buyer also, and we will have a lot to learn from him as well. And finally, from my neighborhood in Mumbai is Dr. Parthiv Sanghvi. He is a general and laparoscopic surgeon with special interest in GI and breast. And I think we can easily call him a bear. And he has taken a very wonderful position based on his reading of the market today. So with this brief introduction, I now hand over to Dr. Srishti Jain to talk to us today. Over to you, ma'am.
Thank you so much, sir, for today's invitation. And I think Indian women have been managing risks in the family, not just in the stock market, but also in the lives. And I would be sharing my insights from whatever I have learned so far. So I started making this presentation on 25th of September. I'm really thankful to Hiren and Dr. Alok Chaudhary for helping me to, go through this journey of learning the macroeconomics. So with full disclaimer that I'm a normal human being who doesn't know that he doesn't know, right? And I'll be just sharing a little bit whatever I know from this huge universe. So we are talking today about, are we seeing a recession in 2023? What are the macroeconomic indicators which are shouting that, and how, as a retail investor, we can safeguard ourselves and behave sensibly? So we are talking about here a crash or a recession. So routine corrections are 20% or less, but then we talk about a market crash, they can go up to 30%, 40%, 50%, and we have seen crashes of 60% also historically. So we have to practice defensive investing since many of the outcomes are likely to go against us. So it's very important to ensure survival under negative outcomes than it is to guarantee maximum returns under favorable ones. So हमें average return मिल जाए bull market में, but it is also important that when we are heading towards a bear market or a recession, we are able to safeguard our profits and we are able to sit on the sidelines sensibly. So market moves in a pendulum form. So when we see the extremes of the bull market, we have to understand that nothing goes on forever, and this moves in a cyclical way. And one day it also has to come back. And markets hardly ever spend time in their medium. Either they are on the bull extreme or they are on the bearish extreme. So I would like to quote Benjamin Graham, the author of Intelligent Investor, which every investor reads. The market is like a pendulum that forever swings between unsustainable optimism and unjustified pessimism. And if we want to become an intelligent investor, we have to realize and buy from the pessimist. Right. So let's go through a brief history of past crashes. Average bear market would last for 349 days. This is an average duration. And the average declines that have been seen in the past are around 35%. So history doesn't repeat itself, but it often rhymes. And why we are talking about crash today, and how historically certain indicators which flashed before the recessions of the past and what are the flashing today, we will understand all of that. So historically, we will be talking about these crashes, which we all have seen. And the first crash which we saw was 1929 stock market crash. Then 1987 was the Black Monday crash, 1999 dot-com bubble, 2008 financial crisis, that was the global financial crisis, housing market collapse, and to 2020 we saw the coronavirus crash. And many veterans are now expecting that in 2023 we will see the mother of all crashes. And historically, each crash has been worse than the previous crashes. So it all starts from a domino. एक चीज टूटती है and then the chain reaction starts. That's how the domino effect happens in the stock markets. So let's go back to 1929 crash, and that was a Black Tuesday. And what happened then? So it was the month of October again, 1929, and the market had enjoyed a huge bull run for 9 years. And what happened was that in the New York Stock Exchange, that because of the increased valuations and increased released monetary policies, the market had really gone into the bubble phase. And when the panic got created, when the Wall Street bankers, they couldn't find a solution, they had to sell their bonds in distress because people were withdrawing money, and hence there were also margin calls. People were trading on margins. There was a euphoria on the street. And then on October 28th, the margins calls had to be withdrawn, and then finally a panic came, and Rockefeller family also tried to save the market and tried to show faith in the markets by buying during the fall, but no one could save people from that crash. And it was historically the Great Depression, that's what we call. Then came the 1987 stock market crash, and that was again a Black Monday crash in the month of October. And we saw 1 week, we saw 10% selling, and then another week we saw 25% selling. And what we have seen historically is that whenever we see the crashes actually start from the top, and the people are unaware, the common people are just not aware, and they are just taken aback. And this is the 1987 picture of the Sensex. At that time, I couldn't find the Nifty graph, but the Sensex graph, and the Sensex had crashed around 36%. And this bottom came from the peak in about 640 days. So that's how long it lasted. That was around 2 years that it had lasted. And just remember, if we buy on the top, for example, in 1987, we were buying on the top and we were buying throughout the fall, it would have taken full 2 years for us to come to the same level before we would have got another fall as well. So buying on the top is not what value investors do. We have to understand the economic cycles. We're not saying that we are timing the market, but we have to know where we are standing in the current cycle. So what happened in 1987? So there was a declining dollar and trade deficit. Then the bond yields became attractive. I hope the bells are ringing, and that's what is happening now. The market was overvalued. The portfolio insurances were there. Computer trading had started. Margin call and illiquidity and derivatives had come new darlings of the Wall Street. And that's how all it started. Again, it was a Black Monday in some countries, Black Tuesday in some countries, and it was again in the month of October. Right. So what had happened at that time? Again, there were difficult monetary policies, government, people were losing faith in the government. What's happening now? The bond yields were increasing, and everything led to a panic. And that's how the Black Tuesday started of 1987. So this is an interesting article from Investors Business Daily, and William O'Neill was the editor of Investors Business Daily for many years, and he wrote this, that looking back, that can we identify the areas of distribution, and can we prepare ourselves and identify for these big crashes to come. And Nasdaq Composite, there were 4 days of distribution before the actual fell off came. So it had broken the 50 days moving averages, and there were 4 days of distribution. What had happened? I would really suggest everyone to read this book. It's a beautiful book, and you really get to understand it on the third or the fourth reading, and it makes a lot of sense, and it really helps you to learn how to sell. Now let's talk about a scam which happened in India, and we all know about 1992 Harshad Mehta scam, and Suchita Dalal, a reporter who identified it 4 years ago before all that happened, and how everything fell into place. We all know about the story of Harshad Mehta, and from the peak and the to the bottom, it was around a 53% fall in the Nifty at that time of the scam, and it took 456 days approximately for the bottom to come. And as you can see, the Nifty was enjoying its euphoria. We were on the peak of the bull market, and people were suddenly taken aback, and many people lost their savings of life in this scam. Then came the dot-com crash, or the 1999-2000 crash. And at that time, what happened was the tech bubble valuations had become insane. Any company of dot-com people were investing, and Nasdaq enjoyed a 9 years continued bull run from 1990 to 1999. And what happened exactly? Then the results of the companies started showing in, and they were not giving the results as were expected by the street. And then again, a panic came, and venture capitalists started withdrawing their money, and then a panic crash came. And what happened at that time was that all these Amazon was launching company, everyone was launching the companies, and so many companies had just gone busted. They were not able to make a money at all. Everything is there on Google, and you all would be able to read it. So companies had become extremely overvaluated, and people who were smart had started to realize that. They had started moving money from stock market to bonds, and everything which we see during the recession had started happening at that time. So this is the chart of the Nasdaq at the peak of the dot-com bubble. And just to calculate the crash, what happened? There was a correction of 82% on the Nasdaq from the top. And as you can see, that if you were not prepared, if you're not understanding, and if you were not fearful when everyone was greedy on the street, you would have lost all your savings at that time. And the bottom came in around 924 days. It was a very long, distressful period for the street. So 924 days means approximately 3 years from top to bottom to come. And as you can see, there were intermittent rallies, but then all the rallies failed, and it was a very bad period for the market historically. And what we saw in Nifty was, at that time, there was a 53% correction, and that happened over 1,117 days. That was around 4 years it took for the bottom to form. In March 2000, we saw the Ketan Parekh scam in India. And again, we will see in the next slide that what led to Ketan Parekh scam. He was one of the people who was working with Harshad Mehta at that time. And from the peak, we saw around 55% correction in Sensex. And as you can see, before the crash came in, the markets were at their peak. And again, for the bottom to form, it took around 1,112 days. So it took that long, around again 3 years, 3.5 years for the bottom to form before the market could again stand. So Ketan Parekh, a modus operandi was that there were 5 traders trading in the same security again and again, and they were manipulating the prices, and they were hyping this. So it was happening under the cover until obviously every scam has its life, and it has to be busted. So again, another chart which I found was that stock market crash in that year was around 50-55%, right? So Ketan Parekh was trading in these tech stocks, and they were called as the K10 shares at that time. The International, Satyam, all run back. See, they were his favorite crashes. Then I think 2008 crash became more popular amongst us because we could see the movie, The Big Short, and it became really very famous. And many people who started investing after those years came to know through movies, which I'm glad that it was picturized. So what happened at that time was that the subprime mortgages, they were increasingly sold in the markets because the bankers really became greedy. They were giving loans to the people who were not having stable jobs, because the subprime mortgages, they got more interest, like 11% interest. So that's why they were selling loans to the people who were not expected to pay them back timely, right? So during the 2008, there was a peak of the housing market. CDOs were being sold, and those housing bonds were called as AAA rated by the various rating agencies. AIG was selling insurances against those bonds, and people were so confident that nothing can happen to the housing market. And finally what happened was that the banks got busted. Lehman Brothers had got busted, Bear Stearns got busted, and big losses were faced. And who were the people who were making losses? They were the poor people. They were the normal general population like us, who had trusted the banks and saved their money there. So in the 2007 meltdown, it took around 2 years for the bottom to form, right? So this is how the 2007-8 crisis came. And during that time in Nifty, we saw a 62% correction from the top. And again, you can see that the market was at its peak, and it just came aghast. People were not ready for it. It was not a market which was slowly moving. People didn't get time. And again, the bottom took 434 days to form before the market starting to stand up again. So 50 years crash in 2 years because of internet bubble. And again, it took 4 years to recover to the same level. And again, as soon as it came to its prior past top, we saw 42% correction in 1 year because of the unregulated financial institutions. So buying on the top has never been a very sensible idea. Then most of us have lived through the 2020 crash, which we all think that it came because of COVID. But the situation in 2019 was quite similar what it was in 2007 before the crash came. Again, the bond yields had started to rise, the dollar index had started to rise, the interest rates were more, economy would have anyways faltered. But what happened was the COVID came, everything got blamed on COVID, and things got the things got preponed by some time. So if it would not have been COVID, it would have been some other reason. So 2020 COVID crash was one exceptional recession which had a V-shaped recovery. And that's why we think that the bear markets last very short, because that is what we have lived and seen, most of us. So it was a 37% correction approximately, and that lasted very shortly, just for 2 months. And then we got a full blown V-shaped recovery from there. So we just went through all these 5 biggest crashes in the history of stock market. Now let's see what happened in a single day in the history in these crashes of 21st century. So on March 12th, 2020, the COVID crash, we saw a single day crash of 9.9%. In 2008, October 15th, we saw a single day crash of 7%. March 9, 2020, 7.7%, December 1st, 2008, 7%, October 9, 7%, September 17th, 2001, and that was 7%. So we have seen such 7 to 9% crashes in one single day, and which had created panic in the past. Again, some more examples of single day crashes. Some examples are from the Indian stock market as well. And as we can see, Harshad Mehta scam, one-day loss was 12%. Financial crisis, 24th October, one-day losses were 10%. And hence, for these all historical dates, one-day losses have been anywhere between 5.5% to 13%. And no one was ever ready for that until and unless you were digging deep into the economy and were aware and were not greedy and had sold your securities on the top and had been sitting on some cash at same levels. So biggest single day crashes again, as we again saw another slide. We get very few of these slides on internet. And again, the crashes were between 5.9% to 13.15%. And these are the largest 2 weeks of crashes. And the Wall Street crash was around 33%, Black Monday 31%, and we saw 2 weeks crashes anywhere between 33% to 8% in the past history. Again, how much time did it take for the recovery and how much for the recovery? So let's take the recent 3 examples. In the 2008 financial crisis, there was a crash of 57%, but then we got a recovery of 326% from the bottom. And again, we will see in the last slides that how much have we come so far after the COVID crash bottom. Right. So this was another crash which I could find on internet of 22nd May 2006, in which on a single day we saw 5% of crash, and that was when Congress or government came into power. So this was the news from New York Times, and we saw that the first statement was that after defying gravity for months, Indian stock began a rough descent. So that's how they had written. Right. So all these historical crashes history is available on the internet, and there's a good detail on the Wikipedia as well. So let's understand that how, as a simple retailer, what are our red flags for just becoming aware. So as we all have to understand that we are sitting on the top of the market and peak of the market, and hence when we are at the peak, we really have to think defensive. We have to protect our capital. So let's understand this by DCBA. We intensive care people are very fond of ABCD. So here we go in the reverse order, and that is DCBA. So D stands for dollar index, C for crude oil prices, B for bond yields of the US treasuries, A for American market indices, and that are NASDAQ, S&P 500, and Dow Jones. So let's first understand that why so much buzz about America? Why we are just not so happy and gala about our Indian economy? So let's just understand where are we in front of India and why we are saying that if the Titanic sinks, we will also get sunk along with them. So here is the latest data of economies by the GDP, and US economy GDP is $26.85 trillion, and we are there at $3.74 trillion. We are 9 times smaller than them. So what is US dollar index? So dollar currency, if we compare it to the other currencies of the world, which are of that weighted strength. So if we compare the dollar with the other currencies like the euro, the Japanese yen, the British pound, the Canadian dollar, the Swedish krona, and Swiss franc, we see the dollar index. And as we can see in this chart, this was the chart of 25th September, that there is a weekly breakout on the dollar index, and the prices have moved above the 10 weeks and the 30 weeks moving averages, and there is a golden crossover, and the dollar index is getting strength. So what we have to understand with dollar index, if the dollar prices, the dollar is increasing against our currency, that means our currency is getting weaker. That means our purchasing power to import anything from US is decreasing. We need to spend more of our Indian rupee, and that is not good for us. The dollar index rising is not good for us. And this is the chart from today, that we are still, we got a little bit of a retracement over a few days, but then we are still at the verge of the breakout of dollar index. So crude oil prices, historically, we have seen that crude oil prices, they rise a lot when the economy is really in going towards recession. But actually, when the recession comes, the crude oil prices drop suddenly. In COVID, we also saw that the crude oil prices had plunged to zero, but they really rise a lot before the beginning of the recession. And as we can see on the crude oil, this is the daily chart. There is a breakout. And if we see on the weekly chart, the dollar, which had peaked in 2022 in November, December, and it was around 130, 140 a barrel. And again, we are seeing that again, the prices, after correcting a lot through the beginning of the year, they have now again started to show a U-turn, and they have again started to rise. Now, starting from our DCVA, the B stands for the US Treasuries bond yield. So historically, if we see that if the stock market is not doing well, people will go in debt. If the debt market is not doing well, people would go in stock, right? So the 10-year US Treasury yield is now at the 2007 levels. They have been rising steadily. The reasons are multiple. Number one, the Fed has been keeping on increasing the rate. We are historically at the interest rate of 5%, and hence the treasuries are rising. And understand that if we are getting a safe return from a debt fund, why we will go to an emerging market? What our FII is getting, because usually they get a Sensex yield from us of around 5%. But if we are getting the same yield from their own country, from their own US safe bond treasuries, there has to be a very strong reason they come to us. They come to us if they get a value. Are they getting a value right now, coming at all-time high? I think no. Then this is the US 2-year Treasury government bond yield. And again, that has been rising steadily. And that is again at the level of 2000, 2007, 2008 levels. US 1-year bond yields again is at the level of 2007. So we have to understand that whenever historically since 1960, we get an inverted bond yield, that has been a very strong pre-indicator of a recession. Whenever it has happened after 1960, a recession has come. Now, what do we understand by inverted bond yield? So normally what would happen if you are investing in bond for a long-term bond, you will be getting more yield, and for a short-term bond, you would be like getting lesser yield, because since you are giving money for a longer term, you're taking a longer risk, you get a larger yield. But when it get inverted, that means for a shorter time, you are getting a more yield, and for the longer time, you're getting a lesser yield. That is called as inverted bond yield. And that is a very, very strong sign of a recession coming in. And for the last 1.5 years, the bond yields have been inverted, and they have been deeply inverting. So something is cooking up really wrong, and we have to understand that what the smart people are doing right now. So this is where we are today, and we see that whenever the bond yields had gone inverted, 1990 we saw a recession, we saw the dot-com burst, we saw the global financial crisis, we saw the 2020 recession, and now here we are today, right? So again, showing the 10-year, 2-year US Treasuries bond yield. And as we can see, we are inverted at a historical level, and it has to strike a bell that are we at the beginning of a recession, and how can we safeguard ourselves from it? So again, there are different graphs trying to show the same thing to understand that why we should be so cautious when we get the bond yields inverted. US government will have to save the bond market. The bond prices have been crashing badly, and the only way to save this would be either to decrease either to decrease the interest rate, which they're not going to do now because the inflation is still not controlled, or the stock market has to crash. So let's compare the 1987 curve to the 2023 curve. And I think that should ring a bell, that when in 1987, the 10-year treasuries had started yielding more than the stock market, and that's where we are today. The yields of the bond is more than the stock market. We have to understand that, and we are somewhere around the same level where the Black Monday crash had come. Now let's understand what value investors like Warren Buffett, Ray Dalio, and Howard Marks are doing. So what have they done? So Warren Buffett is standing on a 147 billion pile of cash, right? So he has a huge cash position since last year. He has been moving into treasuries. He's not happy about the stock valuations. There's again a tech bubble, and whenever there's too much money chasing too few valued stocks, we have to see what these veterans are doing, not what they are saying in the news. So here we are, Mr. Buffett sitting on a huge pile of cash. So these were the indicators as on 6th of October, and these were the world indicators where so many countries were showing strong technical sell on the weekly charts and some on the monthly charts. But again, technically there is no weakness in indices of our country as of now. But again, we have seen the historical charts. We really don't get a lot of time. So Bank of Japan, which is one of the currencies against the dollar in the dollar index, has not increased the interest rate. They are still have a liberal side of the economy, and they've kept the interest rate same. So that means that the Japanese yen will be weak and the dollar stands strong against the Japanese yen again. So we have to see the option expiry calendar of the US stock market, and we have a VIX expiry coming in very soon on 18th of October, and we have the option expiry coming in on 20th of October in the US stock market. So these are the days where we have to be really cautious and on our safeguards. So FII selling pressure has been going on since 2021. As we can see, historically, they have done a mass exodus from our country. And these are the people who really come into our country or in the emerging markets when they really find value. So here, as of now, in 2021, 2022, until now in 2023, they have shown a big exit. They did come to us shortly from starting from March 2023, where the market had bottomed at 16,800, and Dr. Arun had helped us a lot in that time in increasing our conviction to invest good in the market. And from there onwards, we got a 3,000 points of bull run. We saw the markets peaking at 20,200 after 16,800. That was a big jump that we saw in our Indian equity markets. So these are again the activities of historical activities of the FIIs, and as we see till now. So again, mass exodus in the last 3 years. So what are the possible drawdowns in the Indian indices coming from the history of the recessions that what we have seen in the past recessions? So this is where we stand. We are at the peak. We will also see that how much percentage have we come up from the COVID bottom. So we feel that one line of defense would be this, that is the pre-COVID trend line of the market top, and that would see around a 26% correction. The another thing which can happen in panic, anything can happen in panic. This is stock market. No one can predict where the bottom would come, but another bottom possibility could be the lows of the COVID trend line, and that would show a 53% correction on the Indian equities. That again, anything is possible. These are all the probabilities. So again, dollar index has been continuously showing us pain so far, and that is the dollar index against the Japanese yen again. And if we are talking again about the bankruptcy filings in the US, we are seeing the largest bankruptcy filings in US since 2020 and since 2008 Great Recession. So historically, what has happened is that whenever the Fed has said that now we are not going to increase the rate, we will pivot, that's where the crash had started historically. So in the last meeting of the Fed, they had said that we are not increasing the interest rates, but they left it open. They might increase more, they might not increase more, only time will tell. So as we discussed that right now at this level of Nifty, the yield from US bonds is more as compared to us, the emerging market. So FIIs don't have any reason not to exit from our markets as of now. Right? And as we are talking here today, and as we are standing here today, we are seeing that the Sensex earnings yield are around 4.1%, and the US 10-year government bond yields are 4.77%. This is something which should really ring a bell and tell us about the valuations of the market. So the Nasdaq index on weekly chart, it has broken the 10 weeks moving averages. NASDAQ is NASDAQ 100 index, and it includes the 100 non-financial top 100 non-financial companies of the US stock market. And this is the NASDAQ chart today. Again, it's at a very crucial level. It's again at the top. The point is, it's again at the top, and we need to see where things are gonna go from here. Now, this is the today's charts on Dow Jones Index, and it has broken the 30 weeks MA. So people who understand the Stan Weinstein stage analysis, which is one good way of investing and trying to prevent their portfolios from a big drawdown, is that whenever that stock after a big up rally has broken the 30 weeks moving average, one should be really cautious and stay away. One should think it as a selling trigger and should not buy it unless the downtrend has been complete, it has found support somewhere, and then the prices have again started to move up above the 30 weeks moving average. Again, a very good book to read, Stan Weinstein. After reading 2 to 3 times, it's when you would understand. So what we can do as retailers right now, we can put a trailing stop loss and trail our profits if we are not confident of whatever if whatever I'm saying is not making sense. But at least I think trailing stop loss is something which we can all do, and we could all understand if any of our equities are trending below 30 weeks MA after a very good run up. I think it's time to sell and have our systems in place. We all know the story of Yes Bank. What happened to Yes Bank in 2018-19 when it broke the 30 weeks MA? There was just no bottom coming in, and from the peak 400 rupees, it just kept on correcting, and had come till 10-12 rupees. So what we retailers have been doing in the past, we just try to catch the falling knives. We're like, okay, it has gone cheaper, let's buy more, let's buy more, let's buy more. And because that is all over the news, that's what the new people want. They just want you to keep on buying so that the smart people can keep on selling. That's how it happens, right? So it should have rung a bell that we would have seen Yes Bank rising over a period of 4,700 days, gaining 3,000%. And after that, we were catching a falling knife, which should have really rung a bell. Again, another stock which was a darling of the street, Reliance Communication. And again, I think it rings a bell. We were buying it after a 334% run up. As and when it was falling, the retailers were buying it and trying to catch a falling knife. And we all know what happened to Arcom. It is now trading at 1 rupee, between 1 and 3 rupees. So these are some good books to read from which we all can derive some wisdom from. Howard Marks, two of his books, The Most Important Thing and Mastering the Market Cycles, and Ray Dalio's book, Changing World Order, already shared about William O'Neill, How to Make Money in Stocks, and Stan Weinstein, Mark Minervini. These are another some great books for technical analysis. And technical analysis, as Arun sir always says, that it keeps you out of the emotion. Technical analysis would not let you listen to anything but to your own system, and you would be able to take a more sane decision. So the most dangerous thing to buy is something which is at the peak of its popularity, and at that point all favorable facts and opinions are already factored in into its price, and no new buyers are left to emerge. So obviously we are not trying to create a panic here. All what we are trying is that market fluctuations are your friend, and if you are at peak right now, this is the time to have something in your pocket, some profit booking, some safety measures in place, not holding on to losses, understanding the system, and reading. So Nifty PB historically right now is very expensive. They've very smartly changed the method of calculation of Nifty PB. So the ideal PB ratio, which should have been 4.57 as shown in this chart, has suddenly dropped to 20% because they have silently changed the method of calculation so as to make look Nifty PE ratio or PB ratio attractive for us. So they changed the method of calculation of PB. They changed the method of calculation of PE ratio 2 years ago in March 2021. So we cannot compare the historical PE ratios. We can just see the 2-year data. And for the PB ratio, we just have to see from this month onwards, they have changed the method. But historically, we are extremely expensive right now. So we would always say, okay, I'm a long-term investor. I don't care. I will keep on holding. So just to let you know, if you're buying on the top and if your portfolio stock goes down 60% down, it would take a 150% run up to come to the same level, right? So please be aware of this slide and pin this slide that holding on to losses is not a smart thing. We are not mutual fund investors who have coming in of money. We are simple retail investors who have limited capital. So again, we saw the news coming in of the attack of the Hamas on Israel. We don't know. There are uncertainties of war and what happens during the wars. Historically, what we have seen that crude oil prices keep on rising, and US is in a very stressful position right now. They have very less days to fill up their petroleum reserves. Just few days are left, and the oil is very expensive. And now they are saying that they will buy the oil at $60 a barrel. Again, it's impossible without a recession or a stock market crash coming in. So while we are talking today, we got the CPI inflation data of the US stock markets, which is 3.7% against the expectation of 3.6%. There is inflation, there's gross inflation. Car insurances inflation is there at 18.9%. Car repairs inflations, transport inflations. So again, as people, analysts are saying that this is the mother of all recessions that can happen, right? And this is again another very important indicator, and that is the LEI indicator, that is the US leading economic index, and it continues to signal recession after contracting for 14 consecutive months. So whenever it has contracted, the recession has followed. So where are we right now? As a common man, we have something shocking similarities which we are facing like 1987 right now. The bond yields are rising. The stock prices have still not started to fall. The oil is getting expensive. The food prices are getting expensive. And what will a common man do? He will have to sell his bonds. The old bonds that they are holding were giving an yield of just 1%, 1.5%, and the new bonds are giving an yield of 5%. So the bond market has already crashed 75%. Historical bond market crash has already happened, and the banks are holding an unrealized loss of around 50 to 75%. What will happen if the people who have invested their money in the banks start asking for those money back, right? So what will trigger this fall? Only time will tell. But we really have to understand that this is getting weakened and weakened, and US economy is the mother of all economies. So to conclude, I would say that markets are unpredictable, so that one has to have different scenarios. The idea is that you can actually predict what's going to happen, contradict my way of looking at the market. And that is by George Soros. So we have to understand this, one of the most important thing about the investment risk, that probable things fail to happen and improbable things happen all the time. So where are we right now? So right now we are somewhere near the peak, and where we want to buy and where we want to sell, we want to sell in the, we want to buy in the beginning, we want to buy before the mania starts, and we want to sell before we are at the peak of the euphoria, right? We don't have to wait for a new paradigm, we don't have to wait for a new all-time high, because then our emotions will come into play, right? And we can get bull trapped. All these possibilities are there. This is a chart of the Wall Street psychology index, and this is how happens. Market runs in cycles. We see the peaks, we see the falls, we see the troughs, and that's how it happens. So the only thing which is certain in the markets so far is that the cycles, these cycles have been happening and will keep on happening, because it is we human beings who are handling this market, right? So we human beings are the ones who are the same, our psychology is the same, our greed and our fears, they all are the same, right? So this is what the usual cycles are. We come to a peak, expansion ends, a recession starts, and the recession ends and the recovery starts. That's how it has been happening so far. So where are we right now? Just someone can please mute their mic. We're getting a lot of disturbance, right? So where we are right now, as far as the Indian equity markets are concerned. So from the bottom of the COVID crash, Nifty has gained 166% so far. Nifty small cap index has gained 319% so far in the last 1,300 days. Nifty mid cap index has gained 280% so far. So call yourself a long-term investor if you have been holding from those low levels till now. But then if you have been buying very recently at the market top, something should ring a bell. I think I would stop here. These are some interesting movies which one can watch. These are the acknowledgements from where I could help and learn a little bit of what's happening around. And the bottom line for my conclusion would be, I would request to please learn fundamentals and technicals and read. It's an ongoing practice. Otherwise, it's better to stick to mutual funds, SIP as a safe investor. We should understand basic macroeconomics and geopolitical understandings. We should not be greedy. We should understand that market runs in cycles and it's a pendulum. We are not timing the market, but we are trying to know where we are. Sometimes equity, it's sometimes debt, and sometimes gold. Always keep cash in hand. Invest judiciously. 100 minus age for a 40-year-old, a 60% into equities, it's decent, and it is applicable for most of us with average knowledge. Risk management is the key, and hope for the best, but be prepared for the worst. Thank you so much.
Wow. Thank you, Dr. Srishti. The word that comes to my mind just now is the movie that is there with Akshay Kumar. Oh my God! So this is really something that is very frightening. But I also remember seeing a YouTube set of an investment expert who said that we have to remember one thing, that whether it's a human being or the stock market, आखिर तो हमको सबको ऊपर जाना ही है. So these are two sides of the coin. And I think now I will ask our experts to give their comments. So may I start with Dr. Arun Kumar Singh? Whether you agree with Srishti or not, irrespective of what could be, if there is a long-term investor who is asking you a question, till the end of 2023, should I buy, hold, or sell? What would be your recommendation?
After so frightening speech, I really reconsider my opinion. But after checking all my charts, all my Indian as well as international charts,
yes,
I still stick to my old view. The market is going to be up for a very good bull run ahead. Nifty, my long-term target is still 10,000 points, still up from this place.
Right.
So I'm still bullish, not on an emotional basis, but purely on a technical chart basis. And
excellent.
the more important thing is when you saw on every important news, important international channels, they all are telling you, okay, it is going to be doom. So it is not going to be doom.
All right. Right.
If it is so common, when the 70%, 80% population are saying the market is going to tank, then 100% market is not going to tank.
Understood. Understood. Dr. Parthiv Sanghvi, I will ask the same question to you, because when we discussed, you said that you have sold everything and are sitting on liquid. So do you think that long-term investor should sell just now or hold or buy?
So, sir, thanks for first and foremost to invite me for this lovely discussion. Now, there have been multiple factors. Of course, Srishti's presentation has evolved over the days, and I have been going through it and discussing on a routine basis with her. What has really struck me after a presentation since September end is the fact that the market is definitely overvalued. Even if we remove all the points, if we discount the points of the falling US economy, if we discount other points of the amount of money coming into the market, one thing is for sure that the market is extremely overvalued, especially the small cap and the mid cap segment. Was that, yes, the large caps have not performed over a period of time, so it could be a possible rally in the large caps. But the problem here is overvaluations. If you see any stock more than its intrinsic value, it is overvalued. Now, overvalued stocks just require an excuse to fall. So I have been guided by many people, including some patients of mine who are also traders. So they've always said that when you get a Nifty of 20, 21,000, definitely do some profit booking. You don't know where the market will go. Secondly, US bond yields, the short-term bond yields, that really struck me, that 2-year bond yields are going really high. That means that in the short term, the inflation is increasing to such an extent that people would want to park their money in US Treasury bonds. Third, Warren Buffett is sitting on a pile of cash. Now, he is not a fool. He's at the age of 93. He's not a fool. He knows where the market is going. And last recent data, I don't know how many of y'all must have read about it, that 8-year bond yields of the Indian securities is also at an all-time high. Now, when the Indian security is also going at that route, I think here people are in a bit of denial for the simple reason that nobody has ignited a possible crash. We have always seen a crash when it takes place. Here we are talking about an imminent crash, and that is why most of us are in denial. But one thing is sure, that over the past few days, since I have sold all my stocks, of course, I am still invested in my mutual funds and my SIPs are going, because that's the best way to average or hedge my portfolio. One thing is sure, that I don't need to see money control on a daily basis as to see where my stocks are going up and down. Does not give me an adrenaline surge also if my stock goes down, or does not give me happiness if it goes a little bit up. But overall, I have seen, sir, with a diversified portfolio, even in a Nifty market of 19,800 or 19,900, my overall valuations or my profits have not gone beyond 20% to 20%. It's not gone beyond. So I think it is a good time to profit book, wait for things to happen. Historically, in the month of December, US companies do profit booking because they want to show a good balance sheet, because there is a year ending over there and they want money for Christmas. So it's a trend that the market does fall in December. We are sitting in October. I think it's a nice time to enjoy for a change, sitting on good cash, waiting for a good dip to take place. Even if it takes to 14,500 of Nifty, the first support level, I will be taking a very measured outlook over there, and I might pump in a good number of money at that point of time if I see some shoots of a rising market at that. The only thing which is contrarian to Srishti's view at this point of time, the only one simple thing is the $2 billion rupees inflow in the form of SIP in the mutual fund market, which is somehow keeping the market afloat till date. That is what I feel. God forbid if we have some big event take place, and then we need to see on that SIP folio of 16,000 crores every month, how does that change? Because that will really impact the market.
All right. Malay bhai, you are the only non-doctor in our expert this time, and you have 32 years of experience. And, working for Kotak Securities at the vice president level is really very impressive. So what is your opinion?
Good evening, and thank you, sir, for inviting me for this webinar. A very good presentation, Dr. Srishti. My views remain that I am a bull in the market. The reason I am looking at fundamentals more. Okay, bond yields are driven by the hike in interest rates which have happened in the US, but has the economy cooled off? Has the numbers of the economy, US economy, have dwindled? No. Look at the home sales in India. Look at the auto sales in India. The demand is growing bit by bit, and we are reaching into another level altogether. What we can see for a short term is a small dip, a price correction, but I do not foresee a crash-like situation in the next 6 months or so. That's my take on the economic scenario, technical markets, all put together.
Right, right. Dr. Parthiv had mentioned about adrenaline. Hiren bhai, you are an endocrinologist, so you know dopamine, adrenaline, and other endocrine hormones. So, what is your opinion after taking the balance view?
So basically, listen, inverted yield curve and the leading US leading economic index, they have been a very good indicator of upcoming US recession, and they have never been wrong in since last many decades. Only once the 10-year, 2-year yield was wrong, but 10-year, 3-month yield has never been wrong. Leading index has never been wrong when
Right.
it is 5% down year on year. So all the things are suggesting that recession is coming. So when recession is coming, you get minimum 20 to 40% fall is minimum any recession. So second thing is the dollar index. Just now the dollar index has started going up after today's CPI data, if you can check it. And even more important is the bond market crisis. So so what I can understand from my learning is that no one is buying US bonds.
All right.
The biggest buyers of US bonds were the government, US Federation, Japan, and China. So none of the three were buying US bonds. So who are buying bonds? The banks, the institutes, and public. So they are not the big buyers. So they are buying bonds, and but what is happening since last 2 years is the value of bond is going down because of rise in yield. So even the banks who were buying US bonds like Silicon Valley Bank, or which we saw that March crisis happened, and the crisis happened because they were holding US bonds in losses. So they were unrealized losses. And as the yields are going up, the unrealized losses are going to go up further up. So in March, the crisis was contained by US Federation. US Federation provided $250 billion liquidity to the banks. Somehow they stabilized and contained the crisis and postponed it. And but now the Federation has again started taking out the liquid. So it was a temporary liquidity to the banks. It was not a permanent solution. So they have taken out $70 billion out of that $250 billion. And the same thing happened before COVID crisis also. Like in 2019, there was no banking crisis, but the banks were in need of liquidity. And at that time also Federation provided $250 billion liquidity. And in February 2020, US Federation took out the liquidity and the crash happened in February, March 2020. So the blame was on COVID, but the Federation purposefully took out the liquidity and then the crash happened. So the similar thing is playing out right now as well. So once the bond market, since last 2 years, bonds, the value of bonds is going down, but it has been slow and gradual.
Right.
So that is why there has not been any panic or crash. But the last, we all know, whenever the fall happens, there is last panic, fall, and capitulation everywhere. So that last panic, fall, and capitulation in bonds is pending, which might lead to banking crisis and other issues. So that is why I would like to stay away from the market.
Right.
I would like to stay defensive at present.
So we are balanced, two positive and two negative. So Dr. Arun Kumar Singh, since you are like a bull, what sector and what script do you recommend to buy just now?
I just want to add one small
Please.
point. I am not a bull.
Okay.
I believe what chart is saying is ultimate truth. If market is going in recession, market is going to fall, the chart has to tell us prior to that fall. And there is not a single indicator on chart which says it is going to fall. Number one. Second, India growth story is tremendous. Make in India process, defense build-up, PSU banking, mining reforms, real estate, because that is a rate sensitive. And the whole scenario of doomsday scenario in current context is based only on bond yield. And this bond yield is controlled by central banks. If they start decreasing interest rate, what will happen? The US market and all the market across the world is going to shoot to sky. So we know what chart is saying. Chart is saying the market is going to go up. It means the central bank are going to act in a
Sir,
favor.
we assume that you are right and the market is going to go up. Now I'm asking you what script and what
My top picks
segment
are
would
in
you
the
recommend? Defense.
defense and PSU banking.
Right. Malay bhai, do you also recommend PSU bank and defense?
I would wait a while to buy into the market.
Okay.
I'm not seeing too much positivity in the private sector banks, which have been pointing out that there could be a price correction in the banking sector in the coming days. That is what I am foreseeing. But yes, after a correction is over, then I would be looking to buy PSU banks foremost and followed by private banks. But I would be buying them after a good correction.
Right. Parthiv bhai, you have said that you sold everything and are sitting on liquid money. So if somebody is doing that, if I have done that, where should I park my money in the meantime?
Yeah. So at this point of time, I mean, I have moved a lot of my money into arbitrage funds. Now,
Right.
arbitrage funds typically, they work on the principle of the difference between the cash and the FNO segment. That is where they hedge. So the hedging is between the cash and FNO segment. And typically in these times, it gives you a 7% yield pre-tax. So pre-tax yield of 7% in these present scenarios, I feel is a good thing. You are confident of your money is safe. There are so many good funds for the same arbitrage funds. You can park them, you can take them whenever you want. Within 36 hours, the money is credited back to my account and liquidity is there. So for people who do not have FDs like me, I don't have any FD. I park my money always either in the debt market or in the equity market. So I think that's a good way to park your money at this point of time.
All right. And is there any risk with the arbitrage fund?
Not that I know, because what I've studied of arbitrage funds, what I've spoken to people, so the risk is not there. Yeah, your yields may go a little bit down 1 or 2% here and there.
Okay.
That's it, nothing more than
Right.
that.
But the capital will be protected.
Capital is always secured. Yes, sir.
Right. Hiren bhai, supposing I want to invest in gold today, should I do that? And if yes, should it be in physical gold or in gold bonds?
Investment in gold can be done, but in SIP manner, I think, not
Okay.
bulk buying, because I still feel that gold has some downside remaining, because US dollar index is going up and inflation is going down. So gold has some downside pending, and so SIP can be done in gold, depending upon the individual. So everyone knows the benefits of physical gold and the gold
Right.
bonds. So if you want to invest the white money in the gold bonds, that gives a lot of advantages, interest,
Yes.
tax free. But yes, in SIP manner, I would like to continue it.
Understood. Malay bhai, coming back to you, what is your opinion about Indian bank bonds, like State Bank of India or Bank of Baroda? Is there any value in investing in them?
You can go for government bonds if you wish to. But what Parthiv bhai suggested, I was going to suggest the same thing. Arbitrage funds are zero risk funds, where risk to the investor is absolutely zero. Yields may vary depending upon what they earn and what they pass on. So if it is 7%, it may come down to 6 or 6.5%. But
Right.
there is no risk involved in arbitrage funds.
Perfect. And my final question to Dr. Arun Kumar Singh. Sir, you mentioned about defense. And I think there are some defense stocks which are doing exceedingly well. Hindustan Aeronauticals and many of them. are there any specific ones that you would recommend, or it is all comers in the defense?
You can go for Hindustan Aeronautics, Majgaon Dock, Cochin Shipyard, even Bharat Electronics, because
Right.
they make radars for the each and every vehicle produced in India.
Right. There are some startups that are coming up, and maybe some are involved in manufacture of drones. What is your opinion about that?
Drone is nowadays a buzzword, but Hindustan Aeronautics is going to be the biggest drone company of the India. So
Right.
when you have a blue chip one, then you go. Otherwise, you can plan for some technology-based company which control these drones.
Yeah, absolutely.
Jain Tech.
So, right. So we are now 6 minutes past 9 o'clock. So we are already overshot time, but we've had some wonderful discussions. And I think, Srishti, your presentation has been very like an eye opener. And also, putting out some questions. We have two experts saying that no, we are still, the market is going to go up. Two other experts saying no, market is going to go down, better to book profit. So I think this is a balanced view that we are getting for our participants, and that is wonderful. I must thank each and every one of you for being such an active participant. And before we close, Srishti, I will hand over back to you to have the last word.
Thank you, everyone, and it's always good to have a view of all the sides. And I think, irrespective of everything, as Malay sir also said, and the question is buying on the top the right thing to do? That's, I think, we all have to ask ourselves, and we can't depend on other people. We have to have our own risk management in place, and learning how to trail the stop losses, and learning how to understand. I remember last year when Dr. Arun said ki in fee 700 rupees ka jayega, and we all were like, क्या बोल रहे हैं सर? बट जब वहां से हम लोग पढ़ना चालू करते हैं और सीखना चालू करते हैं, and we start to see what he is seeing, we actually try to learn the technical analysis. And as sir is saying, yes, the charts don't lie, and there is nothing scary on Indian charts so far. But I think I would still be a defensive and a value investor. I am happy that I could take part in a massive bull run throughout the 2020 until 2200, and I feel safe to continue my mutual fund SIPs, and to stay out of the overvalued stocks at the top. That's all I have to say.
Right. Thank you. One last question to you, Srishti. Is there any large cap, blue chip fund, blue chip stock that you would still be willing to be invested in today?
So
like L&T, for instance.
Still invested in PSE sector like Coal India, ONGC, Oil India, because the crude is rising and the energy is the new gold. So yes, Oil India, ONGC, Coal India.
Right. Excellent. Thank you very much, everybody. With your permission, we will end this session, and hopefully we'll plan the next one very soon, and invite you one more time. Thank you very much. And thank you for the delegates and participants. There have been several questions on the question and answer segment, and I've tried to answer them. If there are any more questions, please feel free to email to us. Thank you. Good night, and have a wonderful future.
All right. Good night.
Thank you.
Bye. Good night.
Good night, everybody.
Good night.